Hi everyone, thank you for joining us this morning. My name is Swati Taylor and
And
I'm
I'm
joined
Ashley
by,
Tony.
we're both wealth planners at LGT Vestra and are delighted to host the first webinar in the LGT Vestra InvestEd series. The InvestEd series offers investment training to our next generation, and over the next few weeks we will cover topics within wealth planning, investing practices and sustainable and impact investing. Over the course of the InvestEd programme, you'll be provided with the foundations needed to help you make impactful financial decisions. As part of today's webinar, we will be discussing the impact of tax on your take-home pay, student loans, budgeting and financial goals, cash savings, tax wrappers, and finally, the property purchase journey. We hope to have time for questions at the end of this webinar, though please do make use of the chat function and send your questions through as they arise. If we do run out of time and there are any questions we're not able to answer during the webinar, then please do get in touch with your LGT contact. I understand we might have some non-UK individuals attending today's webinar, and our apologies in advance that you may find this particular webinar in the InvestEd series to be quite UK focused. That said, the section on budgeting and financial goals and cash savings should be helpful to everyone. During the webinar, there are a number of opportunities for you all to get involved, and to start this off, please do let us know more about your current stages of life by completing the following poll, which should pop up on your screens shortly. Right, so it looks like, okay, so the majority of you are currently at university, followed by working in an established role. So I think there'll be quite a few things in here that'll be useful to you today. Ashley's going to start off by talking about take-home pay and the impact of tax. So I'll hand over to Ashley.
Hi everyone, thanks for joining us today. Like Swati said, I'm going to start on take-home pay. So this is the amount of money that you end up with in your bank account at the end of each month, the amount that you can spend, that you can save, and that you can invest. I thought we could start by looking at a payslip. I think quite often it's quite daunting when you get your payslip in, because there's a lot of information here on the screen, and it's you don't always know exactly what to look at. Along the top, you've got your payroll number, your name, the tax period. If you look a little bit further down, you've got your earnings on the left-hand side. This is any money coming into you. So that's your salary, your bonuses, maybe any commission you might receive. If you move across to deductions, this section shows any tax that's being taken, any national insurance contributions, any pension contributions, and any student loan repayments. Swati is going to talk to you in a lot more detail about the student loan repayments a little bit later in the presentation. If you look next to the tax, there's your tax code. And this lets HMRC know how much they should be taxing you. It's generally, in this year, the most common one is 1250L. However, if you've started a new job and HMRC don't know how much to tax you yet, then they might charge you what's called emergency tax. So you might see a code, at the end of the code, you might see M1 or W1. This just means that you might be taxed a little bit more in that month. It's usually resolved by getting a tax rebate back. To avoid this, when you move jobs, just get a P45 form from your previous employer and make sure you give that to your new employer when you move roles. Finally, the figure that we really need to pay attention to is right at the bottom. It's your the total amount paid to you, and this is your take-home pay, the amount that will land in your bank account. I've broken down a couple of different salaries here, just so you can see what, based on a gross annual salary of 25, 30, so on, how much money you would actually end up in your bank account after you've paid tax and national insurance contributions. If we just pick out the £30,000 salary, you can see after tax and national insurance contributions, you'll end up with about £24,000 in your account each year, or £2,000 per annum. I've included a £55,000 figure as well, because this person would also be paying income tax at 40%, where all the other salaries would have been subject to income tax at 20% alone. Just to break this down a little bit more, I've gone into a bit more detail about the £30,000 salary. So each person in the UK that earns less than £100,000 will have something called a personal allowance. This is currently £12,500, and it's that first £12,500 of your earnings you won't be subject to tax on. So if you take the gross salary of £30,000 and you take off the personal allowance, you'll be left with the taxable income. This is the figure that your income tax rate will apply to. This person earning £30,000 will be subject to 20% tax. There'll also be national insurance contributions to come off, and then leaving them with a take-home pay of £24,000, or about 80% of their salary paid into their bank account. I won't go into too much detail on the tax bands. It's quite a complex area, and I've tried to summarise it in a helpful table here. The first £12,500, as I mentioned, is your personal allowance, and there wouldn't be any tax on that. The next £37,500, or taking you up to £50,000, you'd pay basic tax on. Anything between £50,000 and £150,000 would be a higher rate. You'd be a higher rate taxpayer. And anything over £150,000, you'd be an additional rate taxpayer. For income tax, that's 20%, 40%, and 45%. I've also shown dividend tax. So dividend tax is the tax you will pay on dividends that you receive from a company. So this could be that you're a director of a company and you take dividends out of the company instead of salary, for example, or that you have shares in a company and those shares are paying out dividends. So those are the tax rates you'll pay on that. Finally, I've got capital gains tax. This is the tax you'll pay if there's been any growth on this is the tax you'll pay when you sell an asset, if there's been any growth since you purchased it. That's at 10% and 20%. The main exception to this is on your main residence or your home. This wouldn't be subject to capital gains tax. But if you had a buy-to-let property, for example, or any other residential property, then that would be subject to a rate of 18 or 28%. Now that you know how much tax you might be subject to, I thought it'd be helpful to have an idea of how that tax is spent. So at the end of each tax year, you'll get a tax summary from HMRC, which will specifically break down how much tax you've paid and where that's been spent. For the 2017-18 tax year, this was the pie chart, and the main areas were on welfare, health, state pensions, and education. I'm going to hand over to Swati now. She's going to talk to you about student loans.
Thanks, Ashley, that's great. So before we move on to this topic, I just want to clarify that given the short amount of time we have this morning and the number of subjects we want to cover, the focus in the next few slides is on the Plan 2 student loans, which was available to students in England and came into force from September 2012. If there is anyone watching that has a Plan 1 student loan or is resident in Scotland, Wales and Northern Ireland, there's questions regarding these plans, then do follow up with your LGT contact and they should pass on your questions to me. So when we think of university, we know that there are tuition fees. Some of you may be aware these were significantly increased in 2012, with the majority of institutions now charging £9,250 a year. But there is also the additional cost of being at university, and that's your living costs. So if we think about that for just a minute, many students are moving out of home, starting university, and it can be an exciting but daunting experience. Probably for the first time, you now need to manage your day-to-day living expenses. So before we go any further, I'm just going to do a quick poll here and see what everyone thinks is the average amount a student spends per month on their living costs. Okay, so actually the vast majority have gone for the middle answer, which is spot on. So the average student does spend between £750 to £800 a month. So we could call that about £9,600 a year. This will vary geographically across the country. So if you are in London studying, you probably have a bit of a higher expenditure. As you can probably tell, this isn't just limited to Netflix subscriptions, mobile phone bills, or eating, drinking and socialising with your friends when we get back to some post-COVID-19 normality. But it does include paying your rent or your household bills. So that's your council tax, your gas, water, electric, broadband, and things like that, as well as all your study materials and any transport costs. So the good news is that student finance is available to help with both the tuition fees and your living costs. Now, your tuition fee is covered in full by your student loan, and the vast majority of first-time university students will be eligible to receive this. It's paid directly to your university each year, and you do need to formally apply for it each year via the gov.uk website. You also have a maintenance loan that is available to assist with your living costs, and this is paid into your bank account in 3 instalments over the year, generally aligned with the start of each term. So you just need to be careful to manage these funds, given you need to make them last a period of about 3 months each time. The amount you receive in your maintenance loan is, however, calculated based on your household income. So it's your parents' income. And if your household income is above 25,000, then the maintenance loan you would be eligible to receive will start to reduce. And that's because the government would expect your parents to help you in some capacity with your university costs. Now, the table on the slide here shows you the minimum and maximum level of maintenance loan you could receive each year, depending on whether you're studying inside or outside of London. If anyone is planning to live at home while studying, then the good news is you can still apply for a maintenance loan, but the amount you receive would be lower and is still impacted by your parents' income. So as you can see, there is a shortfall between the maintenance loan and the average living expense of a student, which, if you remember, was about 9,600 a year. Additional support may be available via bursaries or scholarships, but it would be prudent not to rely on these and start to save as early as possible so that you can fund for this shortfall. So Plan 2 loans accrue interest at a rate of RPI inflation, which is your retail price index inflation, plus 3%. And that's right up until the April after your graduation. For most courses, this would mean the rates applied for about 3.5 years. And the interest also starts accruing from day one of your loan. So you also have compound interest over that period. So that's interest on interest applied to the loan. Following the April after your graduation, the interest rate then changes and is dependent upon your income, which is detailed in the table below. As you can see, those earning 26,575 or less will have a lower interest rate applied of just the RPI inflation rate. And those earning above 47,835 will have no change in the interest rate that was previously applied. Anyone earning in between will have a gradual increase between RPI and RPI plus 3%. The underlying interest rate that's applied will change annually in September, and to calculate the interest rate, the government uses the March RPI inflation figures. In March this year, RPI was 2.6%. So the interest rate that's being applied to your loans will vary between 2.6% and 5.6%. Now, if we use the £30,000 salary that Ashley was mentioned previously, the interest rate would work out to be just over 3% that's applied to your student loan. So we start to repay our student loan once your earnings are above that £26,575 threshold. The threshold is increasing in April to £27,295. The amount you pay is based on your earnings and not your loan, and it's fixed at 9% on everything you earn above that salary threshold. If you're employed, then these payments are deducted automatically via your employer, so they would appear on your payslip, which was shown earlier on in the presentation. And if you're self-employed, then you need to declare them on your annual tax return. There's one other thing that you should be aware of. If you do happen to have additional income from savings, which are in excess of £2,000 a year, then you'll need to pay 9% of this excess income via your self-assessment. So you'd think that there might be some tax break having to pay this extra sort of payment from your gross pay. Unfortunately, there isn't. So it's just another deduction alongside your tax. So if you go back to the £30,000 salary, you'd then have a deduction of about £25.70 a month, so just over £300 a year. So your take-home pay would reduce to £23,730. If we then apply that sort of just over 3% interest to a student who might have £50,000 in loans because they've just finished university, you're looking at an increase of just over £1,500. So you can see that the repayment is not going to have much of an impact on the interest that's been applied to the loan. So it all sounds a little bit negative so far, but on the upside, 30 years from the April following your graduation, any remaining student loan you have will be automatically written off. So the typical student, this will be around age 51 to 52. It's predicted by the Institute of Fiscal Studies that around 83% of student loans will never be repaid in full. And these loans also don't go on your credit file. So they don't impact you when applying for a mortgage or any other type of finance. It does have a little impact on your affordability because it does reduce your take-home pay. But as you see, it isn't a large amount that comes out. So is it really a loan? Or should we call it more a graduate tax or a graduate contribution? Well, the repayments are paid through the tax system, like your income tax. You only repay once you earn a certain amount, and if you don't earn enough, you don't have to contribute. The amount repaid is also linked to your earnings, so the more financially successful you are, the more you will contribute in total. And borrowing more doesn't increase the repayments. So given what I've gone through, are you likely to repay your loan back in full? Well, it all really depends on what type of job you go into, what the starting salary is, and what your pinnacle salary might be during your career, and how quickly you progress through these salary bandings. So hopefully this table will give a bit of colour to this. There are a large number of assumptions that have been made, and they're detailed at the bottom of the slide. The interesting fact that you can pull from here is someone who starts on £50,000 salary ends up paying more than someone who starts on a £60,000 salary. And this is just because the £50,000 salary individual never fully repays their loan. So they're making payments for the full 30 years, whereas the person who started on £60,000 has fully repaid their loan within 21 years. So if you're looking at this, you're probably thinking, why would you take a student loan out? Well, for individuals who will not fully repay the amount borrowed over the 30-year period, let alone the interest, then the effective interest rate on your student loan will actually be negative, while those who fully repay the amount borrowed, but not all the interest, will have an effective rate of interest greater than 0%, but less than the interest rates I detailed previously. As such, in almost all cases, there is financial value in taking out a student loan, especially as it's very rare that you will have certainty that you'll be able to repay your loan before embarking on your course. So that brings me on to budgeting and financial goals. Having just talked about student loans and the cost of living at university, hopefully you can see that setting budgets and goals is something we should be trying to do as early as possible. So what is budgeting? Well, at the top of this slide, I've put a dictionary definition for you, but it's effectively the balancing of money in with money out and trying to see what is left over to put towards your savings goals. The analysis of your expenditure should also help you to see any habits that you need to change or highlight any particular trends you just need to be aware of. So why is it a good thing? Well, the key reasons are it stops you spending money unnecessarily. It increases your savings and reaches your financial goals faster. And it helps develop good financial habits in the long term, which can relieve emotional stress and improve your financial and mental well-being. So where do we start? The first thing to do is to get together all your paperwork that you'll need, which is basically your bank statements and credit card bills. You probably want to go back 3 to 6 months. It just depends how regimented and equalised your expenditure is each month. You also want details of any household bills that wouldn't appear on those statements. So any annual premiums that you might pay for things like car insurance or home insurance. Have a clear understanding of your net income, the take-home pay, so the payslip that you receive. And also have details of what you're paying away into savings and your pension already, so you know what you're already spending towards your financial goals, and have values of those pensions and savings so you know how much you've built up already. It's also important to have details of any loans or finance agreements you might have so you can understand the payments you're making towards these, and how quickly that they will get repaid and fall away. Once you've got all your paperwork, you then need to filter through and categorize your expenditure. Your essential expenses is the main category, and that's your have to have in order to live. So these are things like your mortgage, your rent, your home insurance, your TV license, council tax bills, gas, electric, and also your food and like grocery bills. These can be split into things as fixed expenses and variable expenses. For instance, your grocery bills would be variable. It's unlikely that you'd be spending the same amount each week on that. You then have discretionary expenses. So any other expenses that are not essential for you to live. What you consider to be an essential expense may be a discretionary expense for someone else. So your budget should be personal to you and consider your own habits. It will make it easier to stick to. Now that you've recorded your monthly income and expenses, you can build your budget using averages as well as your fixed expenses. So taking it back to groceries, if you're spending different amounts each month, you can then add these up to make an average budget for yourself. Make sure your budget also includes actual and unexpected expenses. So we all know that Christmas is coming up. It's unlikely those expenses would have appeared in your last 3 or 6 months worth of bank statements. So just make sure you give yourself a buffer, and where in doubt, always guess high. So now you have your budget set up, you need to keep checking in on it. Put time aside each month to review your expenditure and see how you are doing against your budget. There are a number of free apps widely available on your mobile phones that can help you keep track of your expenditure. Some can be more manual, like ProExpense or BudgetMe, while others can use the open banking network and automatically track the transactions that go through your bank accounts and credit cards and assign them to specific budget categories. Things like Emma or Yolt. To give you a real life example, my fiance and I bought our first house earlier this year and moved in the weekend before the first lockdown in March, and we had put together a budget that was very much pre-COVID-19 and included things that we don't really do at the moment, like travel, either for holidays or work, and just socializing. We actually haven't reviewed it properly up until last month, as we thought, well, we're not really spending money on things, we must be saving a fair bit more. So we'd been really relaxed about it. It turns out that those Amazon deliveries that we've been having, the various number of delivery meals, fortnightly flower deliveries to brighten the house up, and online Pilates classes soon add up, and pretty soon you're not saving as much as you thought you should have been. So speaking from experience, it's important to be disciplined and regimented with yourself. Keep checking in on your budget, and it will help to build good habits in making your finances, managing your finances over the longer term. So now you've reviewed your budget, what are you spending that is not a necessity? So using my example, it's probably the flowers and the frequency of delivery emails. Have you got more coming in than going out? Yes, great. Let's save more and work towards those financial goals. If not, then, well, what can we do to cut down on? Look at those things that are not a necessity and try and move yourself into the green and into the yes. So we do all this and we put budgets in place, and at times these budgets will fail. So they'll fail just because, well, life gets in the way. We have a lack of focus and motivation, or we've set unrealistic expectations at outset. And because we're not reviewing expenditure against budgets frequently or revising them when appropriate, then they just don't come true. And this really becomes a cycle of negative reinforcement. If they fail, then why should we do them? If we can't see successes, we have no motivation. And if we have no pressing financial goals to reach, then it becomes a bit of a burden spending the time reviewing your expenditure, especially when it can feel a bit of a depressing task. Well, the key to understand is that slip-ups happen. We all go through times where we'll spend more than we plan to, but if you review this regularly, you can spot your trends, you can get yourself back on track as soon as possible, and you can revise the budget to make it more realistic if it needs to be. The 3 Ps are the key to success: patience, perseverance, and persistence. So we're going to do something a little bit different now. If I can ask you all to go to www.mentee.com and then enter the code 9140989, or use the QR code at the bottom of the slide. What we'd like to know is, what are your current financial goals? What are you saving towards or thinking about saving towards? You can add as many things as you'd like, and we should start to see a word cloud build up on the screen.
Doesn't seem to be sharing.
It's coming, there you go. Okay, so it looks like holidays and wedding seem to be the big thing. A car.
A few buying houses there, or buying another house there.
So the holidays looks like the biggest thing, and I suppose that's not unusual given everything that's going on at the moment. So
I just saw someone wrote my wardrobe, which I like.
Traveling after lockdown yet? Oh, that's good. Okay, so well, we can see everyone's got a lot of different things there, but holidays, car, wedding, buying a house seems to be quite high up on the list. So now that you have a budget that's working for you and you can see a pattern of saving, the next process is to identify and write down your own financial goals. So these were things that you've listed, like holidays, weddings, deposits for house, and paying off debts. Once you have your personal goals, you then need to sort them into short, medium, and long term. And we should be specific and realistic with your goals as well. So make sure you put the amounts that you need, the time frame that you need to do it, and work out the amount that you need to save each month. The key thing to do here, once you've achieved your goal, is to make sure you celebrate their completion. So rather than having that negative reinforcement that I talked about before, we actually then have a positive reinforcement, and it helps to stick to your financial budget on an ongoing basis. If it helps you, why not celebrate achieving your financial budget each month? Put a little extra buffer in your budget for an extra takeaway meal at the end of the month if you've reached it. So if you're in a position where you have got debt, so not student loans, but I'm talking about credit cards, finance agreements, personal loans, things that will have high rates of interest, then you'd strongly want to consider paying these down first before diverting your funds into savings. If you're in the position that there is no debt, then consider paying yourself first each month from your net pay. Put aside an amount each month in your budget for savings and treat it as an essential expense. My dad always used to tell me to save, to pay myself 10%. So if my paycheck hit my bank account, it was 10% would just go straight into savings. The other thing to consider is make use of your employer pensions. Now, Ashley will touch on this in a little while, but they're effectively giving you free money by enrolling into your employment pension. And at the end of the month, if you still have cash left over from your net pay that hasn't been allocated or used by one of your budgets, then be disciplined and sweep it into an easily accessible savings account. It can help to build up your emergency fund, or might be needed in a month or two when you have a slightly higher expenditure month. And of course, if you have got month after month after month where there is surplus income, then you probably need to go back and revisit your budget and increase your allocation to savings. So I'm going to pass on to Ashley now, who's going to talk about cash savings.
Thank you, Swati. We're going to start with a poll here. The question is, how much cash should I save before I start investing? Should pop up on your screen any minute. Oh, that's great. It does depend on a lot of different things, which I'll go through in the next slide. It is true that interest rates are low at the moment, though, so just to bear that in mind as well. I'm going to start by talking to you about the two main cash pots that I think you need. There's the emergency fund. So this is 3 to 6 months of essential expenses. If you've If you've done your budget, like Swati suggested, you'll know what this essential expenses figure will be. The amount you save in your emergency fund will depend on your situation though. So if you're in a full-time job and you've passed probation, you may feel that 3 months is sufficient. But if you're freelancing, for example, you might feel that you need a 6-month buffer. Saying that, you may work in a really niche job and feel that if you lost your job, it would be difficult to find another one. Or you may be a freelancer and have lots of people on a waiting list wanting to work with you. So it really just depends on your situation. This money would be used if there was an emergency, and if it is spent, you want to start rebuilding it pretty quickly. So probably stop saving into anything else and just save into this until you've rebuilt that up. The second part is for your short to medium term needs. So we talked about a lot about holidays and traveling. I imagine those are hopefully on the agenda in 2022 or 2021 actually. With these, you want anything that you think you might need to spend within the next 5 years. We've any longer term goals that you might have that might occur in longer than a 5-year period. You might consider investing that to make a bit of a return. The situation you don't want to be in is having to sell an investment because you need to access those funds. So if you're investing for a longer period, you'll be seeing out any fluctuations in the market. So there are a couple of considerations to make when saving cash. Where to save it firstly. So you can save it in a bank instant access account, a cash ISA, a fixed deposit account, fixed term deposit account, or something like a national savings and investment product such as a premium bond. The interest rate that you'll receive on these accounts varies quite a lot, so you'll need to do a bit of research. You can do this by looking at the bank websites. Most of them put up the different accounts and different interest rates on there, or else looking at various other websites such as Money Saving Expert, where he consolidates the different rates available in the market. Your access to these funds is quite important. So when you'll need access to them, if it's your emergency fund, or you intend on going on holiday in a month's time, or saving for Christmas, then you probably want those funds in an instant access account so you can access it as soon as you need them. But you might have more medium-term goals, which you can afford to lock up some of those funds for slightly longer. The longer you lock those funds up in something like a fixed term deposit account, the higher the interest rate usually is. I'll talk to you a little bit about protection as well. So there's something called the Financial Services Compensation Scheme. This is protection if the bank that you were saving through was to fail. It's up to £85,000. That does apply across different accounts. So if you have a current account with the same bank as the bank that you hold a savings account with, then that 85,000 will be split between the two. And it's also just important to be aware that some banks share licenses. So an example of that would be HSBC and First Direct. So if you had accounts with both of those banks, then it would be 85,000 across both. The exception to that rule is national savings and investment products, which are government backed, and so the £85,000 limit doesn't apply to them. That money is safe. So once you've saved into an emergency fund and for your short to medium term needs, you might think now it's time to start investing some of that money. We've got a webinar on the introduction to investing, which is the next webinar in this series. But I'm just going to talk a little bit about some of the products that you can invest in. These are ISAs, pensions, and general investment accounts. When I talk about ISAs here, I'm talking about cash ISAs and stocks and shares ISAs. These are tax-free accounts where you can invest up to £20,000 per annum into them. You can access them at any point. And like I said, there's no tax within that wrapper. I'll then talk about pensions. These are savings for your retirement. You can save up to £40,000 or your UK earnings into a pension. So if you were earning £30,000, for example, then you'd be able to contribute the full £30,000 into your pension if you had that money free. If you were earning £50,000, then you'd be capped at the £40,000 limit. When you make contributions into a pension, you get tax relief. So if you were to contribute £80 into a pension, then you'd get £20 of tax relief from the government. So effectively £100 would go into your pension, even though it only cost you £80. If you're a higher rate or an additional rate taxpayer, you'll be able to claim further tax relief through your self-assessment tax return at the end of each year. So you can access funds from your pension currently when you're aged 55. This is going up to 57 in 2028, and it could go up further before we reach retirement age. When you do take money out of your pension, at the moment it's 25% of that would be tax-free, with the balance subject to income tax at your marginal rate. So it would be taxed as earned income. So in a similar way to the calculation I did earlier with the salary breakdown, that's how it would be taxed. Then finally, you've got the general investment account. We'd always say to utilise your ISA allowance first and at least consider making pension contributions before you start investing in the general investment account. There's no limits to how much you can invest in this account, and you can access it at any time. There is, however, tax while it's in the wrapper, so there'll be capital gains tax, there'll be dividend tax and income tax on any interest received in that on the funds in that account. It's not the end of the world though, because in a similar way to the personal allowance, where you don't pay tax on the first £12,500 of your earnings, you also have a capital gains tax allowance, a dividend allowance, and something called a personal savings allowance, which you can apply against that to reduce the tax that you'd pay. Clearly, if you've got a lot saved in the general investment account, then there is going to be tax to pay, but it can still be quite a tax efficient wrapper to invest in. Thought I'd talk a little bit more about ISAs. So I mentioned the cash and stocks and shares ISA. They do sort of what they say on the tin. In the cash ISA, you would just hold cash and you would invest in a stocks and shares ISA. There's also a junior ISA, an innovative finance ISA, and a help to buy ISA, which I'm not going to talk about today. But I thought, as there's a few people who are thinking of buying houses, I'll speak a little bit more about a lifetime ISA. So with a lifetime ISA, you can contribute up to £4,000 per year into it. You'd get a 25% bonus. So if you contributed £4,000, you'd get £1,000 from the government. It's mainly used for first-time house purchases. The maximum value of the house that you can buy is £450,000. You just need to be a little bit aware of that. If you're buying as a couple, you can both have lifetime ISAs, but that £450,000 cap would apply between the two of you. It's not that you get £900,000. You also need to be buying this property with a mortgage, so just to be aware of that too. The other time you can access the lifetime ISA funds is at retirement, so once you're over 60. Any other time you draw money from a lifetime ISA, you will be subject to something called a withdrawal penalty. When lifetime ISAs came out, this was 25%. It's currently 20%, but it's changing to 25% again in April next year. So you might think, okay, well, I've got a 25% bonus, so it's not the end of the world. But the 25% bonus applied to the 4,000 per year. If I just use some numbers as an example, just to demonstrate, if you contributed £4,000 and it got topped up with £1,000 bonus, you'd have £5,000 in the lifetime ISA. If the next day you decided that your circumstances had changed and you needed that money and you took it out and it was subject to a 25% penalty, then you'd walk away with £3,750. So you've effectively lost £250. So it's just, lifetime ISAs can be really, really good for first-time buyers. It's really helpful. The bonuses are really helpful in building up that sum of money to buy your first home, but you just need to be aware of the restrictions. So do a little bit of research before you invest in them. I just wanted to talk a little bit about auto-enrolment as well. So this is the requirement for your employer to make pension contributions on your behalf. There's a minimum overall contribution of 8%. This is of qualifying earnings to eligible employees in a company. There's a couple of definitions here, so I'll just go through those. Between age 22 and state pension age, as the eligible employee, you need to be earning more than 10,000 from one job and work in the UK. The qualifying earnings are between £6,240 and £50,000. However, some employers might be a little bit more generous, so they might not apply the eligible employee definition. So if you're 21, you might be able to still join the workplace pension scheme, and they might contribute on your full salary. It will just depend on the company. So just a little bit more on the minimum amount. So that's 3% minimum from your employer. So that would mean that you would need to contribute 5%. This would include a bit of tax relief, but it could be any combination of this. So as long as it's over 3% that your employer contributes, they could choose to contribute 4 or 5%, which would mean that the amount you needed to contribute would be a little bit less. There is an option to opt out of an auto-enrolment pension scheme. Some people do consider this because the personal contributions that you make will reduce your take-home pay. I would strongly urge you to consider not doing this. It is basically free money from your employer and from the government in the form of tax relief. I'm going to hand over to Swati to talk a little bit more about the property purchase journey.
Thanks, Ash. So I think one of the common themes on the word cloud we just did earlier was saving for a property or a second property, I think I saw. And so over the next couple of slides, I'm going to go through the journey of buying a property. Hopefully there's some helpful observations that will assist you as you come to buy your property. The first thing that we should be looking at is building up your deposit. You want to look to save between 5 to 20% of the cost of the home you want to buy. Saving more than 5% will give you access to a wider range of cheaper mortgages. So just keep that in mind. You also need to budget for all the additional costs of buying a property. So there are solicitors' fees and survey costs, stamp duty, although currently that's not applicable, properties up to 500,000 until the 31st of March. And buildings insurance, costs related with your mortgage, such as arrangement and valuation fees, the costs of actually just moving, so your removal costs, if you do use a company to help you with that, and the initial furnishing and decorating costs. So if you have got, you're moving for the first time into a new property, you probably need to buy a sofa, dining tables and chairs, and all the other things that you need, a bed, all the other things that you'll need to furnish your home. As you're going through this process and you are building up your deposit, there's one thing that you should be aware of is that mortgage lenders will ultimately want to review your outgoings and affordability and will request bank statements and potentially credit card statements. And this can be up to a 12-month period. So when they look through this, there are transactions that can have a negative impact on your process. So it's worth just bearing this in mind in the run up to applying for a mortgage. The key things here are gambling, specifically sort of high levels of gambling, and this can include money going out to the lottery. And then anything else really that shows that you can't keep up with payments between one paycheck and the other. So you've got late or missed credit card payments, excessive cash withdrawals using your credit card, excessive use of your overdraft facility, use of short-term payday loans, things like that. Another thing that's also worth thinking about is that if you have a lack of regular saving that's coming, and that your saving is coming just from your bonuses or commissions rather than from your basic pay, then that's also something that can be looked at quite negatively, given the bonuses can be variable. You also want to make sure you can afford the monthly mortgage repayments as well as any increase in living costs. So you've probably done a budget before you get to this stage, but it's worth doing a new budget for the new property to make sure that you can meet all the costs. It's also a good idea to start shopping around for your mortgage. There are a lot of products out there and a lot of different providers, so it's good to find that you need to find the one that's best for you. Just to quickly touch on the different products, so you can have a fixed rate or a tracker mortgage, the difference being here that your interest rate is either fixed at outset, so that can be over a period of time, sort of 2, 5, 10 years, or a tracker mortgage, which will basically track the Bank of England base rate. So you could have a rate that's sort of Bank of England plus rate plus 1%, for instance. There are also mortgages that are called offset mortgages, and these would work well for people who have large amounts of cash for certain parts of the year, potentially because of the way that you're paid. And the cash that you have basically sits in a bank account, and it offsets the mortgage loan, so it reduces the interest rate that's payable while you're holding the cash. You then also need to consider whether you have a repayment mortgage or an interest-only mortgage. The repayment mortgage means that your payments will probably be slightly higher, but you are paying down the interest as well as paying down the capital, whereas an interest-only mortgage means you're only paying the interest, so you'll need to find funds at the end of the term to pay off the whole lump of your mortgage. Once you have found a product that you think is suitable for your needs, it's worth getting a mortgage in principle agreed. This will cost around between £100 and £250 to do, and it can leave a footprint on your credit file. So before you do that, you'd want to make sure you've checked your credit score and you've just looked for any errors that there might be on your credit file. So now, once you've found your home, you want to make your offer. This is usually through the estate agent. There will be some back and forth here until you reach an agreed price with the seller, so don't be alarmed by this. And then once your offer's been accepted, you then need to arrange a number of different things. The first one being a solicitor. Solicitor's fees can go up to £1,500 plus VAT. It really just depends on the purchase price. And the solicitor will submit searches on your behalf via your local authority. This is to check for issues that may affect the property's value. It can cost up to £300 to do this. You then also want to arrange a surveyor who will check for the structural your structure of your property and look for any problems that may be there. There are different types of surveys that the surveyor can do depending on how in-depth the analysis is that you want, and this will vary between £250 to £600. You'd also then want to arrange a valuation survey, and that's normally done by your mortgage provider, and the reason for that is just to ensure the property is worth the price you're paying for. Once you've had all the information back, you may want to renegotiate the price of your new home. Just remember, at this point, neither you nor the seller are legally bound to this. So the seller could even have found another buyer at this point who might be willing to pay more than you are. Once you have got to this point and your offer's been finalised, you'll also want to make sure your mortgage starts to get finalised as well. There will be an arrangement fee. You can have that arrangement fee added to the mortgage, but just bear in mind that you will then be paying interest on the arrangement fee for the life of the mortgage. This fee ranges between £0 and £2,000. It just depends on the product that you chose at outset. You'll then exchange contracts. This is when the property transaction becomes binding. And at this point, your solicitor will pay a deposit to the seller's solicitor of about 5 to 10% of the property purchase price. You also want to make sure you've got buildings insurance in place to cover the structure of the property on the date that you've exchanged contracts. So once you've exchanged, there's then a period of time before you then go to completion. Now that time can be a week, a couple of weeks, or much longer. It all depends on the chain of your property. So your seller will be buying another property and their seller will be buying another property. Once you've agreed a completion date, your solicitor will arrange for the final payment to be made from the solicitor's account to the seller's solicitor. If you are using a lifetime ISA to fund part of your property purchase, then do not withdraw the funds yourself and pay them to the solicitor. This will incur the early withdrawal penalty. What you need to do is allow a solicitor to arrange this on your behalf. You also then need to settle any remaining solicitor's fees, pay the stamp duty that might be payable, and that's within 14 days from the completion date. The solicitor will normally organise that for you, along with the register of sale with the land registry. And at this point, you're ready to move. So you might want to consider moving on a weekday. It might help keep the removal company costs lower. You'll want to ensure your contents insurance commences on the date of completion. And then you just need to collect your keys, which will either be directly from the seller or the estate agent, or potentially the seller's solicitor. And don't forget to keep those essentials easily accessible on moving day so you can celebrate.
Well, thank you, everyone. That concludes our presentation for today. I believe there's been a couple of questions come through, so we'll just have a look at those quickly. Just a reminder that the next InvestEd webinar is on the 19th of November. That's also a Thursday, and it's an introduction to investing.
Okay, so the first question that's come up here was is asking them, what's the difference between a lifetime ISA and a help to buy ISA?
Yeah, that's a really good question. Help to buy ISAs were set up before lifetime ISAs. You can no longer set up a help to buy ISA, but you can still use the help to buy ISA to buy your house. So that's absolutely fine if you've got one.
Yeah, I think the key thing is that the property value on a help to buy ISA is much lower. If it's outside of London, I think it's £250,000 that you can use this towards.
Yeah, and the limits you could, the amount you could put on each year was limited as well. Sorry,
right.
each month, yeah.
The good thing though is that you can withdraw funds at any point from help to buy ISA, and there's no penalties, as opposed to the lifetime ISA. Okay, let's see, there's another question. Is it possible to get a loan to pay off your student loan that would have less interest than what your student loan charges? So we're basically talking about a personal loan here. So, I mean, you might be able to, but as I think I went through earlier, if there's no likelihood of you paying back your loan in full, then the interest rate your effective interest rate is either negative, because you're never going to pay the interest, you're just paying back the loan that you took out, or it's between 0% and the RPI plus 3% figure. So that's going to be quite low compared to a personal loan, which will be around sort of, I don't know, 5-6% at the moment for a personal loan. So
yeah, I think you also need to take.
Doing.
Yeah, I also need to take into consideration the effect the personal loan will have on your sort of credit score and your affordability if you're looking to buy a house.
That's right, yes, exactly. Thanks, Ash. If you have a lifetime ISA and a stocks and shares ISA, is the maximum still £20,000 combined?
Yeah, so you can invest £20,000 across all the different ISA types. You can only contribute to one type of each kind of ISA in each tax year. So you wouldn't be able to have a cash ISA with one bank and a cash ISA with another and contribute to both of those. You'd have to choose which one you went to, but as long as the £20,000 is applied across all of them, that's okay.
Yeah. And can you have a help to buy ISA and a lifetime ISA at the same time?
Yeah, I believe you can. I think I'd have to look into how that worked when you actually bought the house and how the solicitor would apply it, but I believe you can.
Yeah. And then I think the last Oh no, we've got 2 more questions. How does commission work with income tax? So
Yeah, so as I showed on the payslip, your any money you got in, so whether that's commission or salary, that's going to be subject to income tax at the normal rate. It would be taxed as earnings, earned income.
perfect. Okay, I think that's, I mean, there's one more question here, which is, so once I've got my ISAs set up, what do I invest in? Okay, well, I think as Ashley alluded to, the next series, the next webinar in the series is all about what to invest in and the practices of investing. So I think that question will get answered as part of that next webinar on the Thursday, the 19th of November. I think that's just come up on the screen. So that's everything from us, I think.
Thank you so much for joining. We look forward to seeing you next time.
Thanks, bye.